Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
Matt Mondoux, Senior Financial Advisor.
And Daniel Seder, Managing Partner.
So we've got a full agenda for you all today. We're going to start things off talking about inflation. The CPI print last week came in a little bit lower than expected. We're going to talk about commodity and energy markets before getting to some Federal Reserve policy and data uncertainty, the U.S.-China trade update, and finally closing out with the ultimate impact on markets. Spoiler alert, it is hitting all-time highs as an impact. So without further ado, let's start with inflation. Consumer price index for the United States in September 2025 came in at about 3% year over year, up slightly from 2.9% year over year in August, but slightly below forecast. And that's also the same can be said for core inflation, core CPI, which excludes food and energy, holding at that 3% year over year figure, which was actually a little bit better than expected and a little bit more closely watched by parties like the Federal Reserve. So it's no surprise that markets responded strongly. Stocks hit new all-time highs, bond yields eased, and rate cut expectations for the Federal Reserve increased. Matt, why does this matter?
Yeah, I mean, obviously, inflation not only is something that consumers feel and react to, but it's also a driver of monetary policy or Fed policy. When inflation looks better than, more in control, better than expected, it gives the Fed more flexibility to cut rates potentially. And obviously, investors are, interpreting this, that the odds of rate cuts have increased, which tend to be positive for equities, up to a certain point.
Stocks or stocks and bonds?
So, you can get the effect, I guess it depends for bonds, right? If you're having to buy a new bond to roll forward, or if you're buying a CD, it could be a bit of a bummer, right? Because your forward rates are going to be worse than the rate that you received maybe the prior year. However, in most bond funds, you see a commensurate impact with yield expectations and price appreciation. So bonds can appreciate in price when yields go down, but for someone rolling a CD, maybe not as awesome of news.
Daniel, so inflation, as inflation stays somewhat under control, is the idea of a soft landing still in the talks?
I would say absolutely. So it's interesting because the fear, at least as it pertains to the Federal Reserve, has really been more on the labor market. That's why you saw the Fed cut rates. That's why you still have 2 expected rate cuts for the remainder of this year. The only concern with that is as the Fed tries to soften rates, strengthen the economy on the back of some weak labor data, the only concern with that would be, do you overcook the economy a la higher inflation? So we had seen some choppier inflation prints trending a little bit higher, but this type of print on the inflation front does provide more confidence for the Federal Reserve to cut. And therefore, I think that's why the market appreciated it so much, because some of that fear around overheating inflation, at least in the short term, has been quelled.
Got it.
So we'll talk about the Fed in just a moment, but first I want to switch gears over to commodity and energy markets. There is some semblance of impact of commodities and energy in general on inflation and the Fed's consideration. So that's why we want to chat through this first. But oil futures have weakened amid some signs of oversupply recently. And you can think of that as things like record United States production, elevated inventories, and just general trade concerns, which have added to that. At the same time, we have metals, especially some of these critical minerals for energy transition, also having other metals like gold hitting records. Investors seem to be looking for inflation hedges. Even though we just talked through inflation coming in a little bit softer for September, you do see a general preference in the market for some of these hard assets. Why do you think this type of conversation matters right now?
Matt?
Yeah, I mean, it's interesting. I think, from a textbook standpoint, when oil goes down, it tends to signal growth concerns, right? You can be oversupplied for 2 reasons. There's less demand or there's more production. I think in this case, we're looking at it's just a more production. Ever since U.S. shale came online, generally speaking, oil prices have been more muted than they were, back in the early 2000s, because we have more capacity. So that's generally kind of something that doesn't necessarily worry me at this point from a growth concern. It is interesting. Gold has done so well this year. Gold bugs finally have their day. I think a lot of that's been on inflation, but I also think there's been a certain amount of the appreciation in gold that's been due to geopolitics. There's a lot going on in the world right now, obviously, and you're even seeing today. This is Monday, the 27th. You're seeing the reaction. Gold prices are actually down on the news that China and U.S. are back to the table for a tariff agreement. So, it's probably a little simplistic to say gold's moves strictly inflation. I think a lot of it's been due to geopolitics as well.
And at a company level, so companies with large commodity exposure, so say miners or energy firms, earnings and CapEx plans might need to be revised. So this not only affects the economy, or it's impacting companies at a company level too.
Yeah, without a doubt. So obviously things like inventory data and production trends. I would also include OPEC Plus in that because they can meaningfully shift the dynamics from a supply and demand perspective. Obviously close things to watch and seeing how that factors into future CPI prints. But I want to flip over to the Federal Reserve now. So as it pertains to that inflation conversation and precious metals and all these things, with this government shutdown ongoing and the Federal Reserve slated to meet this week, we have this situation where the Fed doesn't necessarily have the best data to work with in terms of their ability to make a decision. That has very much been a buzzy conversation. So it's like the Bureau of Labor Services actually reopened last week just to release the CPI data. But we still don't have job figures from September. And as I mentioned before, this is very much the driving force behind why the Fed has started to cut rates. So right now you've got a Fed that is, along with the market, trying to balance optimism from some rate cuts with some caution because we still have some somewhat elevated inflation, a weakening labor market, which puts growth in uncertain territory. So why does all this matter? Because the Fed is essentially flying blind at this point. The market seems to have disregarded that. Do you think that it even matters at this point?
Dan, do you want to take the first stab at that?
Go ahead.
It's probably too early. Dan, maybe you recall, or Daniel, you recall. I don't even believe. I think kind of the expectations for the next rate cut were December, anyways. I don't think from like the Bloomberg Fed funds forward-looking outlook for rate cuts. I think that the next cut was scheduled or anticipated by the market to be in December. So I think you'd be a lot more worried if you had multiple rate cuts expected before then and the Fed was flying blind.
I thought, and I have to fact check this, but I'm pretty sure the market, as it pertains to Fed funds futures, have a cut in October and then a cut in December as well.
Yeah,
I thought there was two.
Okay, so there being two. I mean, I think you start to worry that there could be more of a policy mistake. That's valid. It's probably a little early. I mean, I think we're talking about 50 basis point potential in cuts from 4.25
right
Fed funds rate. I wouldn't lose sleep over it, but yeah, I mean, the longer this goes on.
Yeah, I would agree with that. To me, it's just a little bit. This just makes the situation a fair bit more complex because just as we started to see this real weakness start to emerge in the labor market, what I would call a pretty pivotal piece of data in the September jobs report that just is not available for the Federal Reserve to work with. I just think that that's actually ends up being material. And so while I do think you're going to still see the Federal Reserve cut rates by 25 bips here at this meeting at the end of October, it's just going to leave. What they will end up doing is very much be vague with their forward commentary, talk about how they're going to be data dependent because they really don't have anything else to say.
Well, and let's go back to the first point here too. The inflation print certainly gave them cover to make this cut.
Correct.
We'll reevaluate for December.
That's correct. Well, and I would say just kind of jumping over to talk a little bit on the trade front, I do think that the market is certainly finding optimism here as well. So we have this renewed optimism around a trade deal. Matt, as you said it, a framework for a framework, right? You know, between Donald Trump and Xi Jinping from China, with some reports coming out that these negotiators on each side have reached a very successful framework. So as you would expect, global equities are heading higher on some of this trade hope sentiment. You have markets setting all-time highs, even international shares, companies out of Europe climbing modestly. I mean, do you guys think that this matters at this point? Because it's really like, I feel like the market has come to expect something positive to come out of any conversation. So even if one party comes out and says something outrageous that they don't fully intend on going through with, the market seems to have looked past that somewhat. So I really don't know if this matters or not.
I think it matters. I think it matters a ton. It's just hard for any of us to really know what's going on behind the scenes. To be a fly on the wall in those negotiations would be amazing. I mean, think about soybeans, right? And how much in soybeans China is buying from the United States. So these relationships matter a ton. And the tug of war is real. It's back and forth, and everybody wants to make sure that they're not offending the other side, and you have to show respect, and you have to make sure that you're not saying something too offensive today, and then tomorrow it's a full-blown attack. So who knows where it goes? I think eventually it gets worked out. There's I guess at the end of the day, who holds more cards, but I think China matters a lot. It matters a ton.
And at the end of the day, too, you know, markets are buy the rumor, sell the news. Generally, is kind of the old adage. But I do think markets love momentum, and this is a signal of positive momentum. You know, so momentum can build and build and build, and you know, this is that kind of first reversal in potentially negative momentum to positive momentum, and that shift matters.
I saw GDP print in China was something like 4.8%, which is pretty low for China. I mean, what do you think about that?
I'm just generally skeptical of
any of the
anything
figures
that China would print. I mean, it could be right. I'm not totally discounting the fact that but for me to like stake anything on that, it kind
of I couldn't have said it better myself.
Yeah, I feel like I might have better odds, you know, participating in Chauncey Billups' poker game.
Well played. R.I.P. Okay, well, we'll wrap up with some of the market impact here. I mean, we've already alluded to the fact that softer inflation print and expectations for rate cuts and productivity on this trade relation front have all led to markets hitting record highs. You know, valuations have certainly been in the spotlight. You have these growing concerns around the fact that valuations are lofty, and you've got this uneven economic data. And some of this policy optimism between U.S. and China and other parties might already be priced in. What I would say in response to this is that we have an earnings season that has kicked off with roughly 86% of S&P 500 companies having beaten their EPS estimates. Granted, this is not the bulk of S&P 500 companies. I believe we have 50% or so of S&P 500 companies reporting this week. So all I'm trying to say is that, yes, valuations in specific sectors like tech are above their 10-year average on a trailing basis. That doesn't mean that the market is inherently overvalued just because stocks have run. I think that what's going to matter a lot more than a simple point-in-time valuation snapshot is hearing from management teams, looking through the actual company financial statements to try to understand, are we still seeing the level of productivity that we expected to see? And like I said, so far the answer is we have, based on the companies that have reported. So obviously valuations matter, but to me, right now, it's really more a matter of who's performing well, what types of businesses are working, right?
Plus, there's momentum. I mean, it's just we're in a defined uptrend. I think we're close to 12.5% above a 200-day moving average. And so what investors have to be constantly reminded of is that a pullback of 10% from current levels would still keep us above what would be a critical uptrend line, a line of support. So I think momentum is important. Momentum is going to continue to play out. Valuations are stretched in a handful of companies, but the average stock is still fairly valued. Stock selection matters, but the stock market does not move in one direction, which is up. So pullback of any sort, we're 4% above the 50-day moving average. A pullback of 4% would be nothing other than normal. A pullback of 10 to 12% would still be normal and considered an uptrend, staying in the uptrend.
Yeah. Anything else before we recap and head on our way here?
Good here.
All right. Well, talked at the beginning around inflation with a softer CPI print, chatted through some aspects of the energy and commodity markets as of late, discussion on the Fed, U.S.-China trade relations, and then finally some thoughts on U.S. market valuations. Well, thank you so much, as always, for joining us for another episode of Blue Chip Now. We look forward to speaking with you again soon.